All righty. Welcome to today's workshop. We are going to be discussing and talking about earning side income. Is it a hobby or a business? Understanding the IRS hobby loss rules. So we are the Taxpayers Help Center. My name is Amiel Duncan. Listed below is our website, www.taxpayershelpcenter.com. And then I do want to let everyone know that today's presentation is being recorded. So if you don't want to be in the recording, go ahead and keep your camera off and make sure your microphone is muted. So before we start, I'm going to go ahead and talk about who we are. So once again, we are the Taxpayers Help Center, which is a nonprofit tax organization here in Northridge, California, and we have two tax clinics. So our first one being our low-income taxpayer clinic, which is the LITC, and here is where we help taxpayers resolve their tax disputes with the IRS. And then our second clinic is going to be the VITA clinic, which is the Volunteer Income Tax Assistance, and this is where we help prepare income taxes for free. So Masu Shatoni, he's a CPA, he's the director for both clinics. And then my name is Amiel Duncan, and I'm the director of outreach for the LITC, the Low Income Taxpayers Clinic. Now, how to support or get involved with our clinics. Individuals and businesses can go ahead and support us financially by donating funds to help us expand and reach our services. And then they can also volunteer their time or expertise to spread awareness about our services. And then we help taxpayers both locally and beyond as well. So not just in Los Angeles County. We are an IRS authorized certifying acceptance agent, a CAA, for the individual taxpayer identification number, also known as ITIN application. So if you or anyone you know needs to apply for an ITIN number, you can always go ahead and call us and we can go ahead and set up an appointment. And then to stay connected, we once again are located here in Northridge, California at 9029 Reseda Boulevard, Suite 209. You can call us by phone at 818-366-0111. Once again, our website is www.taxpayershelpcenter.com. If you have any questions on today's presentation or just any questions about any tax queries, you can go ahead and email us at info@taxpayershelpcenter.com. And then lastly, like I said earlier, today's presentation is being recorded and it will be uploaded to our Facebook page, which is Taxpayers Help Center, Inc., a nonprofit tax organization. So if you feel today's presentation was helpful to you, you can go ahead and share this with a friend or a loved one, or you can just simply go back and review everything that was discussed today. So with that being said, we're going to jump into the presentation. Earning side income, is it a hobby or a business? Understanding the IRS hobby loss rules. So, introduction to hobby loss rules. So the IRS distinguishes between activities conducted for profit and those done for personal pleasure or hobbies. Section 183 of the Internal Revenue Code limits deductions for activities not engaged in for profit, referred to as hobby loss rules. If classified as a hobby, you can only deduct expenses up to the income earned from the activity with no losses carried forward. Now, some key questions would be, why does the IRS care about distinguishing hobbies from businesses? And what are the consequences of hobby classification? So the first question, why does the IRS care about distinguishing hobbies from businesses? So there's three reasons. The first one being tax revenue. So the IRS wants to ensure that taxpayers are accurately reporting income and paying taxes on profits from genuine business activities. If an activity is classified as a hobby, it may not be subject to the same tax rules. The second reason being deduction limits. So businesses can deduct ordinary and necessary expenses related to their operations, while hobbies have limited deductions. The IRS wants to prevent taxpayers from claiming excessive deductions for activities that aren't intended to make a profit. And then the last reason being fairness in taxation. So the IRS aims to maintain fairness in the tax system. If hobby losses were allowed to offset other income, it could lead to unfair advantages for those engaging in nonprofit activities over legitimate businesses. And then moving on to the second question, what are the consequences of hobby loss classification or of hobby classification? So for this one, there are four. So the first one being limited deductions. So if an activity is classified as a hobby, taxpayers can only deduct expenses up to the amount of hobby income. This means that if the hobby generates no income, the taxpayer cannot claim any deductions. Number two is going to be no carry forward of losses. So losses from a hobby cannot be carried forward to future tax years to offset income. This limits the taxpayer's ability to use those losses in later years. 3 being increased audit risk, which is continuous losses reported from an activity classified as a business may trigger IRS scrutiny and audits. The IRS may challenge the classification and disallow deductions if they believe the activity is more of a hobby. And then the fourth, consequence would be reclassification by the IRS. So if the IRS determines that an activity is a hobby rather than a business, it can reclassify the activity, resulting in tax liabilities and penalties for improperly claimed deductions. Now, Section 183 and the key factors. So Section 183 restricts taxpayers from claiming losses if an activity isn't primarily conducted with a profit motive. The IRS evaluates whether an activity has the dominant intent to earn profits, considering the facts and circumstances of each case. So the Treasury Regulation, Section 1.183 2B, outlines 9 key factors that the IRS considers to determine whether an activity is engaged in for profit or as a hobby. These factors are meant to provide guidance, and no single factor is conclusive by itself. Instead, they are weighed collectively to assess the taxpayer's intent. So now we're going to go ahead and dive into those 9 key factors. With the first one being, let me move this to there we go. With the first one being manner in which the activity is conducted. So are books and records kept? Maintaining accurate, complete, and timely financial records suggests that the activity is run in a business-like manner. For a business, these records can include income, expenses, assets, and liabilities, and they are used to evaluate the financial performance of the activity. Keeping formal financial records allows the taxpayer to track profitability, make informed business decisions, and demonstrate an intent to turn a profit. Now, the second thing you want to look out for the first key factor is, are business plans or strategies used to improve profitability? So the existence of a formal business plan shows that the taxpayer has a clear path toward profitability. The plan might include goals, financial projects, marketing strategies, operational plans, and methods for reducing costs or increasing revenue. If the taxpayer makes strategic changes or improvements in operations in response to losses, it indicates that the activity is being run with a profit motive. And then lastly, does the activity resemble other successful business operations? So with this, conducting the activity in a way that is similar to other successful businesses in the same industry supports the notion that this is a profit-driven endeavor. For example, adhering to best practices in the industry, such as maintaining market competitiveness, following proper licensing, and employing common business techniques, signals a legitimate business effort. So employing professional methods that align with other businesses like marketing, customer relationship management, or inventory control supports the claim that the taxpayer is seriously trying to make the activity profitable. Now, moving on to the second key factor, which is taxpayers' expertise and advisors. So there's 2 things you want to look out for this one. The first one being, does the taxpayer seek advice from experts? So if you're getting advice from experts in the field, like hiring an accountant, lawyer, or industry professional, it shows you're serious about running the activity as a business. This kind of help can guide you on how to make the activity more profitable. And then the second one is, our efforts made to gain knowledge to enhance profitability. So if you're actively learning how to make your business better, like taking classes, reading up on the industry, or learning new skills, that shows that you're trying to make money. The IRS sees this as a sign that you want the activity to succeed and are taking steps to improve it. The third key factor is going to be time and effort expended by the taxpayer. So does the taxpayer devote substantial time and effort to the activity? And hiring competent managers can also indicate a profit motive. So with the first one, if you're putting a lot of time and hard work into the activity, it shows you're serious about it. So the more time you spend, especially if you're doing it instead of other work, the more likely the IRS will see it as a real business rather than a hobby. And if you hire a skilled or experienced person to manage the activity, that's another sign that you're trying to make a profit. And it shows the IRS, once again, that you're treating this like a business rather than a hobby. Number 4, for the key factors is going to be expectation that assets will appreciate. So even if the activity operates at a loss, will the assets gain value over time? So even if your hobby, your activity isn't making money right now, if you expect that the assets you're using, like property, equipment, or collectibles, will increase in value over time, the IRS might see this as a profit-making activity. So the idea is that you're still aiming to make money in the long run, even if right now in the current time, your activity, your hobby is at a loss. Pretty much the same thing as number 4. So number 6. History of income or losses. So continuous losses. If you're constantly losing money, the IRS might think that you're not really trying to make a profit. But if the losses are because of a normal startup cost or things you cannot control, like a bad economy or unexpected events, then the IRS may understand that you're still working toward making this hobby profitable in the future. Number 7 is the amount of occasional profits. So is there any history of profit, even if sporadic? So if you have made a profit at any point with your hobby, even if it happens every once in a while, that can indicate that you're running the hobby with intention to make money. So the IRS will view these occasional profits as a sign that you are working toward profitability, which supports the idea that the activity or the hobby is running like a business. The eighth key factor is financial status of the taxpayer, so substantial income elsewhere. If you have a lot of income from other sources, the IRS might think that the activity is more of a hobby or something you do for fun, rather than a serious attempt to make money. They may assume that you're not relying on this activity for your livelihood. So this is something also you want to keep in mind. This is something that the IRS will definitely look into. And then lastly, the ninth key factor is elements of personal pleasure or recreation. So enjoyable activities. If the activity brings you a lot of joy, such as horse racing or boating, the IRS might not worry that you're doing this or that you're doing it more for fun than to make money. The enjoyment you get from the activity can suggest it's more of a hobby rather than a serious business effort. Now, business versus hobby indicators, here are the key comparisons. So, record keeping. Businesses maintain detailed records while hobbies may lack financial organization. Profit motive. Businesses have clear goals to generate profits while hobbies focus more on personal enjoyment. And then marketing and advertising. For businesses, they advertise to attract customers, and for hobbies, they rarely engage in any type of promotion or marketing. Now, the impact of hobby classification on taxes. So, expense limitation, deductions limited to hobby income. If your activity is classified as a hobby, you can only deduct expenses up to the amount of money you made from that hobby. So, for example, if you earned $500 from your hobby but spent $800, you can only deduct $500. And then we have the no carry forward of losses. So if your hobby costs exceed your income, you cannot carry these losses into the future years to offset other income. You can only use hobby losses in the year you acquired them or incurred them, excuse me. Then we have audit risk. So scrutiny of continuous losses. If you report ongoing losses from an activity and claim it as a business, the IRS may closely examine your tax returns. Continuous losses can raise red flags, making it more likely that you'll be audited. Then we have tax court precedents. So reclassification, once again, as hobbies. There have been many cases where taxpayers tried to classify their activities as businesses, but the courts decided that they were hobbies instead. So this means that if the IRS or tax courts find your activity is more of a hobby, you may lose business-related tax benefits. And then I do have some examples of real-life tax court cases. So we have Buki versus Commissioner. This was in 2023. The main issue or the main question was whether Bucci's farming, real estate, and horse racing activities should be considered businesses or hobbies. For this case, the court looked at a section 183 and related regulations, which outline how to determine if an activity is for profit. Application, Bucci was unable to demonstrate a consistent profit motive for any of these activities. As a result, the IRS disallowed the deductions related to them. And in the conclusion for this case, the court agreed with the IRS, classifying Bucci's activities as hobbies. Therefore, Bucci could not claim any tax deductions for those activities. So to sum it all up, the court upheld the IRS decisions, reinforcing the idea that without clear profit motive, activities can be deemed hobbies, leading to the denial of deductions. The next case we have is Gregory versus Commissioner, which was in 2021. So for this case, the main issue or the main question was whether the boat charting activity was conducted for profit according to Section 183. The rule under Section 183B, deductions for hobbies are subject to a 2% floor on itemized deductions. This means that you can only deduct expenses above 2% of your adjusted gross income. So the application for this case, the Gregorys argued that their deductions shouldn't be limited by these miscellaneous itemized deduction rules. However, they were unable to prove that they had a genuine profit motive for their boat chartering activity. So in conclusion, the court did deny the Gregorys' deductions, confirming that their expenses were subject to 2% limitation. This meant that they cannot fully deduct their losses related to the boat chartering activity. So to sum up this case, the court ruled against the Gregorys, reinforcing that without clear profit motive, hobby-related deductions are limited under tax rules. And then our last example, Saposnik versus Commissioner. This was back in 2019. For this case, the main question was whether the horse-related activities were considered business operations. The court referenced Treasury Regulation Section 1.183(2)(b) and other relevant tax provisions that help determine the profit motive behind an activity. So the petitioners did not keep proper financial records or have a solid business plan. Even though they put a lot of effort, their horse-related activities did not generate any profits. So in this case, the court concluded and decided that the activities were hobbies, which meant they disallowed any losses the petitioners claimed on their taxes. So once again, to sum this case all up, the court ruled against the Saposniks, stating that without proper records and a profit motive, their horse-related activities were classified as hobbies, leading to disallowed tax losses. Now, to avoid IRS scrutiny, tips and best practices, there are 5 that we have listed here. So the first one is to develop a business plan. So you want to make sure that you clearly outline your goals and strategies to make a profit. A solid plan shows you're serious about running a business. The second tip would be to maintain financial records. So use accounting software to keep track of all income and expenses. Good record keeping demonstrates a business-like approach. The third tip is advertise and market. So actively promote your activity to show that you're trying to attract customers and make it a legitimate business. The fourth tip is to show profitability or intent. So even if you make occasional profits, it helps prove that you have a genuine profit motive. So you want to make sure that you're keeping records of any profits. And then the last tip that I have for you today is to consult experts. So seek advice from professionals like accountants or business advisors to strengthen your case and ensure you're following the best practices. And with that, that sums up today's workshop on hobby loss. Once again, feel free to reach out to us at 818-366-0111. You can call or email us at info@Taxpayers Help Center to set up an appointment. You can come in office and meet with either me or Masu Shatoni. And then once again, this presentation will be uploaded to our Facebook page, which is Taxpayers Help Center, Inc., a nonprofit tax organization. So go ahead and share this with a loved one. We have past presentations on our Facebook as well, so you can go ahead and check those out. If you guys have any questions, please let me know. But if not, that concludes our presentation. So thank you guys.